we know more about the security business than we knew 10 years ago, and it it is a tough business to manage. There's a lot of money made in the business, and then throughout Wall Street, I'm talking about. There's very big sums of money made, and then the question is, how does it get divided up between the institution and the people there? And you get to this question. I've often used the analogy of, would you rather, if you're an investor and you get a chance to buy the Mayo Clinic, that is one sort of an investment. And if you get a chance to buy the local brain surgeon, that's another one. You buy the local brain surgeon and his practice for X millions of dollars, and the next day, what do you own? And if you're buying the local brain surgeon, you would not pay any real multiple of earnings, because he's going to have this revelation several days later that it's really him and not you there with your little stock certificate that's producing the earnings, and it's his reputation. And he doesn't care. Imagine Berkshire Hathaway advertising brain surgery, how much business we would do. So he owns the business, even though you've got the stock certificate. Now, if you go to the Mayo Clinic, no one can name the name of anybody at the Mayo Clinic unless you live within 10 miles of Rochester. And there the institution has the power. Now, it has to keep quality up and do all the things that an institution has to do. But whoever owns the Mayo Clinic has an asset that is independent of the attitude of any one person in the place the next day. Wall Street has a mix of both, and there's some businesses that are more where the value resides more in the institution, and there's some where the value resides more in the individuals. We've got a couple of sensational people running Solomon, and they wrestle with this problem as they go along, and they seem to be wrestling considerably more successfully currently than was the case close to a year ago. But it is not an easy business to run, and it's not an easy business to predict unless you have a business that's very institutional in character, and there aren't many of those in Wall Street.
Are you concerned about the rising valuations on the NASDAQ market, where companies trade at multiples of revenues instead of multiples of earnings?
The rising value of what did you say?
The NASDAQ market.
Oh.
Where they traded 10 times revenues or more, 30 times revenues instead of 10 times earnings.
Yeah. Well, we don't pay much attention to that, because throughout the careers Charlie and I have had in investing, there have always been hundreds of cases or thousands of cases of things that are ridiculously priced, and phony stock promotions, and the gullible being led into to believe in things that just can't come true. So that's always gone on. It always will go on, and it doesn't make any difference to us. I mean, we are not trying to predict markets. We never will try and predict markets. We're trying to find wonderful businesses, and the fact that a part of the market is kind of screwy, that's unimportant to us. We tried a few times shorting some of those things in our innocence of youth, and it's very tough to make money shorting even the obvious frauds, and there are some obvious frauds. And it really is. It's not so tough to find the obvious frauds, and it's not tough to be right over 10 years, but it's very tough to make money being short them. Although we tried a few times way back. We don't look at indicia from stocks in general, or from PEs or price sales ratios, or what other things are doing. We really just focus on businesses. We don't care if there's a stock market. I mean, would we want to own Coca-Cola, the 8% we own of Coca-Cola, 11% of Gillette, if they said we're just going to delist the stock and we're never going to, we'll open it again in 20 years. It's fine with us, and then if it goes down on the news, we'll buy more of it. So we care about what the business does.